We're good? So today we're going to go over two different and interesting topics. The first one is going to be 1031 exchanges. We're going to go through kind of the details of it. It's an animal in and of itself, and I want you to leave here with a basic understanding of how it works. And if you ever start to get into this field, or if you're already in this field and you really go down deeper, there is some more material that I can give you, really the nuances of the IRS publications, etc. So let's do that, as well as the other portion of this presentation is going to deal with 1099 reporting, FERPTA issues, and cash sales. So we're going to be here for a couple hours together. The way that I like to do things, and by the way, my name is Lee Offir. I am one of the underwriting counsels for Title Resources. They are the title underwriter. Basically, once you do your closing, they issue the policy. That policy is under our name. So we're in the background making sure that your deals get closed. We're in the background making sure that if there are title issues, we can help with them, we can clean them up, or we can kind of manage the risk associated with them. The way that I like to present is very informal. I need you guys to interrupt me. I need you guys to ask me questions. I need you guys to share your stories if you have them. Especially with this presentation, there's a lot of slide reading, and it's very easy to fall asleep in this course. And so we need to work together to make sure that you guys understand what we're doing, and at the same time, just keep it conversational. I find that the more interaction, the better it is, and you'd be surprised how often you can learn from war stories from the people sitting right next to you that you didn't even know. So with that said, again, don't hesitate, raise your hand, let me know if you have any questions, and we'll get started with the first one. We'll take a couple of breaks throughout today, and after a couple hours, you guys will be on your way. Lorna will be here shortly. She is the representative for the company. She'll have all the sign-in sheets to make sure you guys get credit for why you're here. Obviously, the most important part. Nobody wants to listen to me without getting credit for it, at least. So she'll make sure you guys sign in and do that. Very important, don't forget to sign out at the end. It's silly, and I know it sounds silly, but you'd be surprised how often people just leave the room and drive off, and we have to hunt them down with their cell phones and make them turn around and come back to sign out. So don't leave without signing out if you want to make sure you get your credit. So with that said, I want to make sure everybody can see. We're going to talk about 1031 exchanges today. It's an interesting process because it's a process that allows the... Do you have a question?
No, I don't have.
Oh, okay. It's an interesting process that allows investors, entrepreneurs, business people to defer their taxes going forward, right? And so they have a property. That property has gotten capital gains because we've appreciated in value. Thankfully, the market is doing well. And now, instead of selling it, where they're going to have to pay those taxes to the IRS, and then going out and buying another property, there's a process by which the IRS allows them to say, okay, well, if you're just going to switch this for another investment property, then we can defer your taxes. It doesn't mean it's tax-free, it just means that we're going to let you pay your taxes later. Sometimes you get a gain on one property and a loss on the other. Why do you need to pay the IRS now instead of holding on to your money is the thought process, right? So it's a very handy tool if you work with investors, and I know right now in South Florida there's still a lot of investor funds, although that might be going away sooner than later, but it's still there. And so if you're working with a lot of investors that want this opportunity, first of all, I recommend wholeheartedly make sure that they have an accountant that is familiar with 1031 exchanges. I always tell people, surround yourself with smarter people than you. That's what I try to do, right? And so tax advice, I don't give tax advice because I'm not an accountant, right? And so unless you know the details of it, make sure that you have someone that you work with closely that does know 1031s on the accounting side, because it's important for them to properly fill out the paperwork. It's important for them to properly notify them of deadlines, because this process is all about deadlines and what you're doing. So this is kind of an overview chart, and I don't want to block you here, but it's kind of an overview chart, and you'll see that really what we have is we have the buyer, we have the seller, and we have a third party called a qualified intermediary. What makes them qualified? Absolutely nothing, and we'll get to that in a second. It's just a third party that holds on to both the property in the meantime while you look for another property. And then there's a whole process by which you have timetables, and this is just a very, very rough overview. We're going to get into the details of it. So with that, and I'm going to move to this side of the room. Bueller.
He's stuck.
It is. It's stuck. Tech support. But while he's doing that, and I'll kind of go over the picture of what you're looking at. And basically, it's 6 months. You have 6 months to close and find another property. The 180 days is a strong 180 days. You got to make sure that whatever it is that you're doing now, that's not the only deadline. They also cap you at 45 days to find a replacement property. So if you're doing a 1031 exchange, and we're going to go into the details of this in a second, but just a rough overview, there's an immediate deadline of 45 days to come up with a list of suitable properties. After that, you have 135 days to close. So it's 180 days total to get through what it is that you're doing.
So, but what if you're constantly selling and buying? Like, you know, the people that fix and flip?
Mm-hmm.
They're constantly selling and buying, so that they never pay the taxes?
So they can continuously defer. If they continuously do 1031 exchanges, thank you. What do I need to do? Oh, I can see it. You guys don't need to. And so, you know, they can continuously defer their taxes. So if they're making gains on these properties and it's great, they don't want to have to pay those taxes. If they continuously do 1031 exchanges to the next property that they buy and they sell, they can defer those taxes. And if the market happens to go down and whatever the value is less, they can use those losses to offset those gains.
Okay.
So if they were fix and flippers and they wanted to continuously do that, they just need to continuously do the 1031s.
In other words, there are no limits for that. You can keep going.
You can keep going. You can keep going on these. They're a wonderful tool that allows you to do that. It's all about avoiding having to pay taxes right now, not taxes in general, because you're never going to avoid paying taxes.
Yeah.
But so why do we care? And I'll tell you as soon as we can pull it back up. But basically, there are special contract provisions involved in requiring. Beautiful. All right.
Make sure it goes.
Left and right?
Yeah.
Okay, perfect.
Okay.
All right. So, I'll hold on to this. So why do we care? So there are special contract provisions required when you're doing a 1031 exchange. We have to notify all the parties. When you're putting these contracts together for a 1031 exchange, there's a special provision. We have a special addendum that you guys are aware of that needs to be used. You have to understand the exchange process and what it is that your customer is looking for. It used to be, and we'll go over the history in a second, but it used to be that you could only sell farmland to buy farmland, specific replacement of property. And the IRS has really eased up on that to what the definition is now. As a method of deferring taxes, these have fallen out of favor due to how long it takes for capital gain taxes. They're still here, they're still prevalent, regardless of whether or not it ebbs and it flows. So again, some of the history, Starker changes, right? And so this is where everybody's eyes glaze over. I'll go over this easy, but you have to understand that in the beginning, it used to only be similar property. And so you had to do farmland for farmland. You had to do gas station for gas station. Then in the mid-70s, T.J. Starker challenged that view, and instead of selling some timber property, he wanted to swap it with somebody else with replacement property, and that was allowed. He challenged that with the IRS. The IRS sued him, and they went all the way up to the Supreme Court. Ultimately, the court ruled that, and taxpayers throughout the rest of the community, Congress rewrote the laws and allowing taxpayers to buy any other type of investment property. So really, the definition has eased up into what it is that we're required to swap with. Now, it's just any real property that's used for investment. That's simple. If it's classified as real property and it's used for investment, it counts, which is actually very, very helpful. So again, just a little background on the law. 1031, the number actually comes from the United States Code, section 1031, and it's a non-recognition of gains or losses from exchanges sold in kind. Basically just saying, hey, we're not going to recognize whether you've had a loss, we're not going to recognize if you've had a gain until you're ready to pay those taxes, because really you're still in real estate investment. It's still the same thing, and there's no reason for you to not pay or carry over or not carry over, and so that's what they use this for. And so there's some exceptions. 1031 does not apply to stocks, stocks in trade, bonds, It doesn't apply to securities, partnership interest, and other beneficial interests. Really, it talks about it strictly being used for real estate. And that's what it's going to be used for. So the requirement that the property be identified and exchanged and be completed in not more than 180 days. So the law basically sets out that you have 180 days, but that's not all, right? So you have to identify the property that you're going to exchange within 45 days. This is the most important part. There's a requirement to provide the qualified, the third party that's dealing with this, right, a list of potential replacement properties. So if you have a client that says, listen, I want to do a 1031 exchange, we're going to go out, we're going to look at the properties. Once they get to a point where they're under contract to sell their property to do a 1031 exchange, they have 45 days to come up with a list of properties that they might buy. Not necessarily the property they will, but a list of properties they might buy. And that property that you close on has to be within the list, so you really have 45 days to find replacements. You can find a dozen or so. So long as the one that you're closing in within 6 months is on that list, you're good. So the first requirement is that you identify the potential property within 45 days.
What if you end up closing on the one that's not on the list?
That's a problem.
That's a problem.
That's a problem. So really, as much as they say 6 months, it's really 45 days to find the property. 6 months is just to get your affairs in order to make sure you close and you can have the cash and everything to do it.
So you have 45 days to find. Okay.
And the best part is, who do they blame when you don't find it? They blame the realtors, right? So, you know, it's a double-edged sword. You can have a client, 1031 exchange clients are the best because they're constantly buying and selling properties, but they're also the most dangerous because these rules that come into play, and the first person they blame is always going to be the realtor, right? And so, such properties receive the day earlier on the 180 days or the due date for the transfer's return of taxes, whichever it is, the earlier thereof. Usually it's 180 days. It's never going to be more than 180 days. I'm just going to sneak behind you and steal my coffee.
So the new property has to be the same price, or it could be?
That's a good question. So we'll get to that in a second. Hold that thought. So the basics: you sell your property. The sales proceeds, all the earnings that you got from the sale of that property, go to the qualified intermediary, right? The cash is never given to the seller. They identify the property within 45 days, and then they close on the purchase within 180. Now, really, it's not 180, it's 135 if you spent all 45 days identified, right? And then at that point, their tax basis on the old property is carried over to the new property. It's simple for the IRS. Now, exchanges, simultaneous property between two individuals. These are just some misconceptions, right? It doesn't have to be between two individuals. Residential property doesn't qualify. It can be residential property. They must be of equal value. That's a misconception. They don't have to be of equal value. Now, what happens when they're not? If the first property that you are selling, the first property that you are selling is a lower value than the new property, it doesn't affect them that much because there's no tax capital gains being realized immediately. If the new property is lower, that basis is adjusted. So let's say if you had a $100,000 property and the new property is $50,000, then they can only carry over $50,000 from that first party, and they'll pay the taxes on that other half, right? And so they don't have to be equal values. They don't always involve two properties. Sometimes the 1031 exchange can be multiple parties, multiple properties. They can get really complex. They must involve the same category of real property, land for land, farm for farm, condo for condo, not anymore the case either. So rule number one, both the old and new property have to be held for investment or used in business, right? Which in this day and age, when you talk about investment property, we're talking about use in business, right? And so the old property and the new property can't be your residence. They have to be held for business. Property held for resale being flipped does not necessarily qualify for a 1031 exchange if there's no intent to do a 1031 exchange, right? And so if the consensus is the property has to be held for at least a year and a day. If it's constantly bought and sold month after month, it may not qualify. But if you have flippers that hold the property for at least a year because whatever it is that they're doing, at that point it'll be qualified. The primary reason, if they want to make sure there's a difference between short-term gains and long-term gains with the IRS. And their concern is they don't want people to manipulate the rule by using it for short-term gains and only for long-term gains. So the property is held for at least a year and a day. Now, you cannot sell the property to a related buyer and not realize the tax value. Who are the related buyers, right? And so we can't use this to foil the IRS's plans to collect the money, right? We can't do this with our parents, our grandparents, our siblings, our spouses. It really has to be anything first degree, right, is off limits right off the bat, and the IRS really doesn't matter. But you know, second degree, your aunt or your sister-in-law, something to that effect, might be a different story when it comes to that. Rule number 2, we talked about this. This, I think, personally, is the most important rule, right? You have 45 days to identify the property. So from the date of closing of the sale of your old property, once you close, you have 45 days to complete a list of properties you want to buy or exchange into, right? Weekends, holidays are included, so it's 45 calendar days. You taxpayers can list up to 3 properties without value limitations. So it could be, if you're selling a $100,000 house and you have a $1.5 million purchase, that's fine. There's no cap limitation on what you're going to buy. And so if the seller lists more than 3 properties, the combined purchase price cannot exceed an aggregate of 200% of the sales price. So if you have an intention on purchasing, let's say you're selling your $100,000 home, and instead you say, you know what, I want to buy 3 Sunrise Lakes phase condos, right, at $30,000 a piece. At that point, you can buy them so long as the aggregate doesn't go above the 200% rule, right? So if they exceed this, the exchange might be disallowed. The list has to be delivered to the qualified intermediary, who we often call the exchange agent, by the deadline, even if the deadline is a holiday. You have to get the list of your properties to the exchange agent. The list must be prepared in a way that the IRS could take it directly to the door of the property. Basically what that means is you have to identify the properties, right? The list has to identify them. I always recommend using the legal description. I've seen people use the shorthand legal that's provided by the tax appraiser. At the end of the day, if a surveyor can find the property, you're good. But you want to prepare it so that at least that it can be found. And it has to be in writing. So as a listing agent, you have to find yourself looking for a property or a group of properties, right, involving a specific value. You'll be shopping. You're not just showing. You're looking for these properties because that deadline is it. Once you hit that 45 days, it can't be amended. Your target does not have to be the same kind of real property, provided that it is still real property and it's for investment. It does have to be within the U.S. or the U.S. Virgin Islands. So it has to be a U.S. property. You can't exchange it for foreign properties, right? The exception is where property is sold overseas. The property you buy must also be overseas property. Now we're talking outside of the realm unless you're an international realtor as well. Rule number 3, and before I get to rule number 3, I just want to introduce Lorna. Oh, even better, even better.
I do want to pass out the signing sheet so you guys can get credit, so make sure everybody signs it. And I'm also going to pass out a little question, like a evaluation form, so you guys can rate him. If he did a bad job, please, I want to know.
Yeah, if I did a bad job, my name is Lorna. They inquired to make sure that they get a copy of the PowerPoint.
Yes, I will be sending it over. I was trying to print it. I'm so sorry. That's why I'm running late. But I'll get an email to you so that you guys can share it, and you guys can have it.
Okay. So, while that goes around, rule number 3, 180 days purchase requirement. It's a hard 180 days. From the date of closing, you have 6 months to close on that new property. Your time periods run concurrently with the 45 days. So like I said before, if you take all 45 days, you now only have 135 days to close, right? The IRS does not give extensions on this 180 days. What happens if you miss the deadline? The 1031 is disallowed. They have to pay their taxes on their long-term capital gains, and then they can still buy the property. They're just going to have to front the taxes in the meantime, right? So the qualified intermediary, rule number 4, taxpayers cannot touch the money. It doesn't go to the seller. The buyer gives it directly to the closing agent, who gives it directly to the qualified intermediary, right? By law, the taxpayer must use an independent third party to handle the money. To be a qualified, they prepare the exchange documents, they hold the proceeds of the sale. They have disallowed exchanges where the documents have not been prepared correctly. So this is just a small tip here. while anybody might be qualified to be a qualified intermediary, make sure you're working with someone who's done 1031s before. Make sure you're working with someone that does the exchange documents properly, right? We want to make sure that this goes through, and the last thing you want is for it to be disallowed because the third party you chose didn't work out. And again, who are they going to blame?
And the realtor.
Exactly, of course. Who else? Sorry. So, no worries. The IRS does not define who can be a qualified intermediary. So this is where the pitfall is. This is where the trap is, right? So it says who can't be the intermediary. It can't be the CPA. It can't be the attorney. It can't be you as the realtor. It's not, even if it could, I wouldn't recommend you guys do it, right? It can't be relatives, employees, business associates. They're looking for a completely independent third party. Now there's no licensure requirement, there's no professional requirement to be a qualified intermediary, so that's where the danger is, right? You want to make sure you're careful who you refer the client to. You want to make sure that, in fact,
knows what he's doing.
Right, they know what they're doing, and they've done it before, so the documents are properly prepared. So you always ask, you know, financial resources, what are you going to do with the money? FDNC, there are 1031 exchange companies that are designed specifically for this. One of the most important questions you want to ask is about the bonding. Make sure that they're licensed. Make sure that they're bonded at least, so that they have something to protect the money that they're holding. If they're not, you might want to consider a different 1031 exchange company. If they don't have financial resources, you're doing this homework so that you can tell your clients at the end of the day, listen, here's a company I looked at. They have the bond that covers your money. They're financially sound. They've been around for 15 years. They're going to hold the money in a separate account that they account for, whatever. The money is FDIC insured. It's not just stuffed underneath their beds. And so you want to make sure that you ask those questions.
So could you give us an example of some of the companies? Like, let's say I had a customer today, I've never done this. He said, can you recommend a company? How would I just Google it? Or?
Lorna, do we have a preferred 1031 exchange company that we use? I know there's a company called Orexco. OREXCO.
Okay.
They're actually owned by Old Republic Title, but they do their 1031 exchange. They've been around forever. There are companies out there. I'm not sure if we have one that we prefer the use of.
I can find out if we do. I don't know. I know I've used also Exeter 1031, which they also do that, and they've been doing it for a long time.
You'll notice once you Google it, there aren't a lot of major players in this space.
Okay.
There's only a handful of companies that dedicated to doing specifically this, because it's time consuming. It's a niche practice that you really have to focus all your efforts on, right? And so there are a select number. If we have a preferred one, I'll make sure that when Lorna emails the PowerPoints that she'll put that in there as well, please.
What is the cost to doing this?
It depends on the company, right? It depends on the company that you choose. It varies. It really
Like
does
up
vary.
to 1,000, a few hundred?
I think they take into account the value of the property. So I believe nowadays it works more of on a percentage, but it's not more than it would have been to save on the taxes, right? So at the end of the day, it's a business decision. Why would I be doing this if I'm going to spend more money than just paying the taxes to begin with and not have to worry about all this, right? And the timetables and everything. So you go into that, but when you call around nowadays, when you pick your company, you'll get a better feel of what they're charging. Make sure you ask them that in the beginning as well. Title requirements. So the taxpayer who owns the prior property must also be the taxpayer who buys the new property. So if it was, you know, myself with a prior company that sold the property, that same taxpayer, that same tax identification number that is used for that property has to be that same taxpayer for the new property, right? And you cannot change business entities, you can't merge, you can't dissolve. With a partnership or an LLC breakup, you have to break up the exchange for the direct owners proportion. Like, if your client is doing this, tell your client, this is your company until we're done, right? This is what you're doing until after this 1031 is over. Don't merge, don't dissolve, don't open up anew and change business entities. This is what we're using, right? Some corporations that create some tax issues. Boots, right? So the IRS is that's what they call money. What's the boot, right? So 1031 exchanges, the IRS term for the money in the transaction that may become taxable is the boot. So again, I'm selling a $100,000 property. Of that, I bought it at $75,000. I have $25,000 in potential capital gains tax, right? That $25,000 is what the IRS calls the boot. Hopefully, by using a 1031 exchange, I can defer that, and the goal is to avoid having to pay taxes on the boot, right? And so, if you ever hear with that, that's what it's called. So in order to defer capital gains, the taxpayer must buy a property that is equal or higher than the one they sold. Again, if it's lower than the one they sold, we're going to pay taxes on that difference. Yes?
What about if they use this difference in the house to, you know, do something different in the house, do a pool or something, upgrades?
There are methods of accomplishing that, and I think it might be later in the presentation, so hold on to that thought. If it's not, I'll go over it, but I don't want to skip ahead and confuse anyone just yet. So in order to defer all tax gains, the taxpayer must buy property that is higher in value or equal to what they sold. So for an example, Fred and Sue sell their old property for $100,000. The mortgage on the property is paid off at closing, and the balance of $60,000 is transferred to the third party. If they buy their new property for $90,000, they bought down by $10,000. This buy down does not kill their exchange, right? So, but the difference between the old sales price and the new purchase price is taxable. So they sell their old property for $100,000, right? They're buying their new property for $90,000. Just like we discussed, that $10,000 difference, that's taxable. Any questions on that? So the taxpayer, on this example, same tax as before, but instead of buying the new property for $90,000, they decide to buy the new property for $150,000, for which they obtain a loan of $50,000. This means that they will only use $50,000 of their $60,000 proceeds. That $10,000 is taxable. That's an interesting question, right? And so I sold my property for $100,000. I have $25,000 in boot, right? That next property that I buy, if I buy another $100,000 property, I have to put down at least $25,000. I can't walk away with cash. No matter what, I can't walk away with cash. That money has to be reinvested in the property. So if I'm getting a mortgage on the next property and you're advising your client, okay, well, if you're going to buy this property and you want to do it with a mortgage so you can leverage your funds or whatever it is, you have to make sure that they understand they're not allowed to walk away with any portion of that capital gains. Otherwise, it's taxable.
Bottom line, you have to reinvest your money.
You have to reinvest your money, all of it. Yep. So your client has to think about the price of the property sold compared to what they want to buy, the amount of equity that's being put into the new property, what's being netted out of the sale. Those are things you have to consider. In order to pay DO tax, you have to buy the property at equal or higher value, and you have to reinvest, just like we discussed, reinvest your money. So, reinvestment target issues. No one can explain why it's called the boot, except I have a theory, right? Like, there's no reason why they call it the boot. It's an old term back from in the Western days, and that's what they just use it for. So, let's talk a little bit about something different aspect of it, right? This is called a reverse 1031, which is still perfectly fine. So you have a savvy investor, and the guy comes to you and says, listen, I already know which property I'm going to buy to do my exchange. So if they go ahead and they acquire the exchange property first, before they sell their property, it's allowed. It's called a 1031 reverse exchange, right? So quite simply, the intermediary then has to acquire that property. So before, on a regular 1031 exchange, the intermediary holds the money until the next purchase, right? On a reverse, the intermediary actually holds the new property until the sale. So it's interesting because it raises a ton of questions of liability for the intermediary holding a property, right? And so the understanding is the owner cannot own the buy and the sell at the same time. They can't benefit from both properties, right? One property usually is a replacement property that they park with the intermediary. So some of the parking issues of leaving the property with the intermediary. Often, an experienced qualified intermediary, they don't want the liability. So what happens is now you have the additional cost of opening up an entity for that intermediary. The intermediary owns that entity, and the property goes to that entity until the sale, right? They don't get the advantages of ownership that way. Why does this happen? It does when the seller finds a property that they can't pass on. And they know that this is the property that I'm going to get. They're going to buy it now before they sell their property, or they're having a tough time selling their property because they believe it's valued more than it actually is. And at that point, you know, they're going to have to come to terms. So the issues of that are there. On a reverse 1031, usually the intermediary will charge more because they have a higher level of liability. So, the revenue procedures for a reverse 1031, although not mandatory, it sets out 45 days to identify the relinquished property. At this point, by the time they're buying the other property, they already know which is the relinquished property. So it's not mandatory. It helps with the steps to follow along as well. At that point, 180 days from acquisition is still in effect. You still have, from the day that you buy that other property, that you close on the new property, you still have 180 days. You still have 6 months before you can, sell the property, or before you have to sell the property you own. Does that make sense to everybody?
Yes.
And the revenue procedure also gives 5 days to complete and sign an exchange agreement. Generally speaking, you'll have that done immediately anyway. So it has to be titled in the agent's name when acquired. So if they're buying that property, they can't come to you and say, hey, I just bought this property, I want to do a 1031 exchange. That doesn't work. So in order to do the 1031 exchange, they have to title it in the intermediary. So they need to come to you and say, hey, I'm buying this property, what do I need to do to qualify for a reverse 1031? Or if they come to you and say, hey, I have all these properties, I want to buy another one, what do I need to do? At that point, you guys have to advise them. So, some situations that occur that you can anticipate in a 1031. The owner finds a unique opportunity to buy another property before he sells it.